All right, let's get Coach Gino in here next. And Gino, every weekend you do the newsletter over at Tackle Trading. You break all the sectors down, look at the analysis from a rankings perspective that the coaches kind of put all together, and you give some analysis for our pro members out there in terms of what's happening in the market. We bring you in here on a Monday to break those sectors down as well. Can you run us through the defensive or the aggressive areas, wherever you'd like to start, and kind of give us a bird's eye view of what you're seeing from a sector perspective?
Yeah. So, on in the newsletter, we do a top-down approach to the markets, and we did go through quadruple witching Friday, which causes a little bit of volatility. That's the quadruple witching, which was last Friday. We're halfway through the years, guys. It's June, right? So that is when the stock index futures, stock index options, stock options, and single stock futures all expire simultaneously in the market, which is a big shift in money. Then we had the FOMC meeting, right? All this usually causes volatility, just like you talked about in June, on the last half of June. So this is the start of volatility season of June. With that said, Tim, historically, utilities and healthcare are usually the best, which are safety sectors, because of volatility spooks people. They go to safety. Worst historically is financials and industrials. So with that said, we saw that last week. We saw our biggest downgrades in financials. Now, if you're looking at the gridiron, we're on the 20-yard line. We made a pretty big adjustment to financials. We pulled it all the way back to the 40. And like Matt said, yes, it pulled back on the daily, but you got to really look at the weekly charts on a lot of these sectors, because on the weekly charts, you're setting them nicely. I mean, look at financials on a weekly here. And then, as I mentioned on the newsletter, this is one day here. I was expecting a bounce back this week, a recovery bounce, if you want to call it, because the catalyst last week, I think, that caused the most volatility was the FOMC meeting, the outlook on interest rates, and that made the US dollar really jump. That was the only upgrade we did on our gridiron, was the dollar. We actually went from a negative stance to slightly bullish. And it's most like neutral bullish. How's it go on the dollar? It's very overextended. And like I said on the newsletter, it doesn't do that more than a couple of days, then it pulls back. And that's what we're seeing today. So the dollar had a negative effect on financials, had a negative effect on materials, which was our second biggest downgrade, materials, and industrials. And a little bit on energy, So when you look at those cyclical sectors, that's where we had the biggest downgrades. And we talked about that last Monday. We were talking about the different, groups of sectors. We have growth, cyclical, and safety. You can break them down into more than that, but that's just how we're going to keep it simple. Now, as far as safety sectors, we have healthcare, staples, utilities, and real estate. Really, the biggest downgrades in safety we had last week were utilities and staples. Now, these aren't real big sectors as far as market cap, staples and utilities, but utilities, we've got that down as neutral. That's our weakest sector so far. Now, again, let me remind you, like I said earlier, these are usually your winners, healthcare and utilities for June. Not seeing that this year, not seeing that so far, but the month's not over. So that's interesting that the safety plays were actually downgraded with the kick in volatility. So that was real interesting. You see the volatility didn't spook people to safety. It actually made people take money out of the high flying cyclical, which has done really good for a while. So right now I'm seeing a little weakness in financials as far as setups and stocks. But now the winners, we didn't upgrade them, of course, like Matt said, was technology, discretionary. They held their ground, and they are the biggest market cap in the market. In fact, just so you know, Apple, Microsoft, Amazon, Facebook, and then you got Alphabet, which is two symbols, Goog and Google, we call it, right? That's 20% of the market, those 5 companies right there. That's 20%. Those guys are all holding up really good. So it really is its own little sector if you put those 5 stocks together. You want to call them the 4 horsemen, the 5 horsemen, whatever you have it. And that's technology and communication. So when you see all these arrows on our gridiron, all these downgrades, you go, wow, don't you think the market would be downgraded more? No, because you got technology and discretionary, which are a much bigger percentage of the market, and the healthcare hung in there too. And we have them classified as a safety play, but the healthcare did hang in there. It did hold its ground. We see a lot of strength coming back into technology, which held the market up. So all in all, Tim, with the dollar retracement, yes, you're going to see a bounce in those cyclical stocks. We got it this morning, right out of the gate. And in the newsletter, I said, I'm going to give it till Wednesday to see how far this bounce is. Because as you know, this bounce, heck, it could end today, right? It could turn around today. We need to see 1, 2, 3 days and see how far financials recover, how far materials recover, and if the dollar continues to pull back. Mm-hmm. And that we'll see, is this a recovery bounce or is this a trend back in place? But also the technology and discretionary just shook it off. Mm-hmm. So sector-wise, you got to pick wisely. You got to be, okay, you got to watch your sectors wisely. But financials was very, very volatile.
Matty, anything you want to add to what Gino's having to say here?
Yeah, in a couple points. He was talking about kind of what's happening with cyclical into growth into the defensive areas of the market. And if last week we're looking at a marketplace in the S&P and the Dow Jones and the Russell 2000 and the NASDAQ where you basically see money coming out of all marketplaces and flowing into a defensive capacity, right? We know that drill. We know what happens here. When the market gets spooked, it initially sells growth and cyclical and it gets into safety. Initially, it will just go cash though, and then it will reallocate. And so when you have this flight out of equity markets, the flight is typically everything. We're selling everything, and then we reallocate back into a more defensive capacity, typically staples, healthcare, utilities, real estate, gold, these types of financial instruments that are traditionally seen by market participants as safety, defensive. Remember, money doesn't typically come out of the market, it just rotates in the marketplace. And so if last week we saw a scenario where everything was coming out, yeah, you would be concerned about the market's viability at that point. You'd still want to see it play out over time, but you would be concerned. That's not what I saw last week, though. I saw it, and what you're seeing here today, I think, does lead into the conclusion that this is sector rotation happening. And remember, everything in 2021 is simply faster than what we have seen in traditional marketplaces. And so we like to price in things fairly aggressively as market participants these days. And so when you're looking at a scenario where money came out of cyclical, which has been extremely strong for the last 8 months, yeah, you're going to see downgrades in materials, industrials, energy, finance. You're going to see those. But again, what did you see? You didn't see growth get beat up. You saw comms get just slightly downgraded by 5 points because of and not volatility, just simply trying to find support here in comms. But what you saw, and I think it was very telling, is the two sectors that really are pertaining to growth, and that would be the technology sector and the discretionary sector. When you're looking at those two sectors, not only did those two sectors not get beat up last week, but let me come to technology. Technology had one day last week where it was concerning, and it got gobbled up the next day. It never violated even a minor support level. Yeah, intraday analysis was violated, but that's going to happen in every volatile condition. A daily support level was not violated last week on technology. It held its ground in the face of that volatility, and I do think you have to see that as positive for technology and growth moving into the immediate short term. Same thing can be said about discretionary. Obviously not as strong as technology. Technology is up around the 180 level on this that would be on this chart, fighting against an all-time breakout. But I do think you got to be a little bit impressed with discretionary on the backs of the Amazon strength over the course of the last couple weeks. Held its ground, never violated a support level, stayed in that cup and handle formation where you're still looking at a potential breakout of 174 before you see some fairly decent price appreciation here. And so based on what I saw last week, I do got to look at this at this point as traditional sector rotation, money coming out of cyclical into more growth areas of the market, than something that is more concerning with a broad-based sell-off where you really need to see everything subside from a volatility perspective. That's not my take here. I think I got this as rotation from cyclical, where we have some concern, and obviously has had a lot of price appreciation since the election, back into growth. I got the same rotation happening here.
It's an interesting thing we got to keep watching, obviously, to see if this thing can confirm, because a true rotation back into those growth areas, if we can get a breakout on tech, break back up in discretionary, that's a new character for the market, Matt, that we haven't had for a little bit. So
yeah, and I'm not calling the end of cyclical by no means. That's not. Remember the anatomy of a bull market. Things take a break, guys. Mm-hmm. That's what Coach Tyler always says. They take a break. And you know what? When you're looking at those cyclical areas of the market, I'm with Gino. You're oversold on the short term. You're coming into some major weekly support levels. I think the clearest path forward this week is for these areas to get gobbled up in the short term. But the problem that's going to arise is you're going to find some very, very strong resistance levels as it comes back up into price. And so as materials, for example, starts to fight back up into resistance, you got a tremendous amount of resistance between 84 and 86, a tremendous amount of resistance, both horizontal and vertical. So you're going to have some important fights there that certainly could see double bottoms, double tops, and eventually a right shoulder breakout. And you don't have to go far to understand how long right shoulder breakouts can occur. Look at Snapchat here. Could have occurred here, 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 here. 4 months later, Snapchat's still talking about a right shoulder breakout. And so when you're coming to the sector, once again, materials, you could see a right shoulder type breakout, but that's going to take some time. Mm-hmm. And so for me, I'm looking at this first and foremost. Step one, you got to find support this week. Step two, let's see that break. Let's see that fight at resistance, and then stabilize that resistance before we see some degree of breakout. We're very early in that analysis. What we're not early in is we're not early in the potential hype-based breakout that we're seeing in technology. We're not early there. We're not early in the potential right shoulder breakout of 174 in discretionary. We're not early there when you're looking at some of the other sectors like healthcare. You know, you're looking at a potential, neutral type formation with a breakout there. We're not early there. We're not late there either. Or early. You're looking at an area of the market where you still have significant great trades going on. And I just come back when we see these rotations. Yes, it takes all of us a little bit of time to catch up to rotation, but we're in the beginning stages of it, in my opinion, and we still need to see further evidence of this to see true rotation, because true rotation doesn't take days and really doesn't take weeks, guys. It takes months. And the same thing with the cyclical argument of true rotation back in November. That took, 6-7 months to transpire? And so I just think if we give the market, especially those cyclical areas of the market, a little bit of time to breathe, let's see where that pain really is. While that happens, we got clean charts in some of the growth areas of the market.